So for those who may not know, before I moved into the world of venture, I was an operator for 16 years. I led product and design teams at 5 early to mid-stage startups. And in my last 2 companies, I brought Trey in to help us really figure out strategy as well as unit economics. And then in my last company, which I wrote a blog post on most recently, came in with a lot of excitement, hyper growth company, high NPS, and high customer love. Only to discover after bringing Trey in that we had terrible unit economics, and that while we were growing, we were burning a lot of cash in the process. And Trey helped us understand that, and we fixed it, and and we got the startup back on track. I wrote that blog post recently, which I'm happy to share in the chat later. It got a lot of spread. And then a lot of people asked for us to do a session on unit economics. And then, of course, I was thrilled to invite the person who taught me everything I know about unit economics, Trey Pruitt, so the master himself. I was joking with Trey earlier that these are the best slides I've ever seen him produce in terms of product and design. So maybe, Trey, you've learned something from me after all these years. But
make it look pretty,
my teacher up until now. So, I'll kick it over to you. I'm excited about the session today, Trey.
Great. Thanks a lot, Ha, for the introduction. So can everyone, you can hear me okay? And thumbs up? Yeah? Okay, great. Well, Ha, thanks for the introduction, and I hope everyone is enjoying the Founder Summit and not suffering too much from Zoom fatigue all-day video conference. And so, my understanding is that many of you out there are early-stage founders, early-stage companies with the goal of building a large and successful company, which I think is a fantastic goal. And so, my hope is, I've been a CFO in Silicon Valley for the last 15 years and a consultant, as Haas mentioned. And my hope is during this crash course that I can provide you with some mental models and some basic tools to help you understand unit economics and why it's important as you build the business that you're aiming to build. And so, what I'm going to go through is a little bit on what unit economics is, why you should care, and how you can use it in your day-to-day management of the business. And then I think we'll have some time at the end for some Q&A. So first, let's start with an example. And so imagine that we've got a company where consumers receive a subscription box each month. So this is a subscription direct-to-consumer company. This is not a real company. But it is a composite of companies that I've seen in the last 10 or 15 years as a consultant. So, the company is, shipping boxes to consumers. The consumers love the service. It's gone well with the early customers. So the company has raised a seed round and some follow-on VC rounds. Things are really going well. So the company starts to scale, hires a growth team, is acquiring more customers to accelerate growth. The word on the street is, hey, this thing is a rocket ship. They are killing it out there. And ultimately, the company gets to a large size in terms of revenue and customers and employees and of course, valuation. But
Okay, just let me stop you for a second. Just make sure you were sharing your screen.
Yeah. Oh, can you not see my screen? Hold on one second.
No, you were sharing, and then I took over the screen. And
then you took it over. Okay. Yeah. Let me hold on one second. Let me see if I can do that. Okay. Can you see a giant rocket ship?
Beautiful slide. Thank you.
Beautiful. Okay. All right. So here's the rocket ship of growth, right? That everyone is looking for. And so, the thing has just been taking off. It's wildly successful. But we get to this point where, gosh, we're burning cash faster than we'd anticipated. And we need to raise capital earlier than we'd planned. And as later stage investors really start digging into the financials and the operating metrics and really start paying more attention to the fundamental economics of the business, they don't really like what they're seeing. And so the company could raise more money, but less than management had hoped. And so, they have to reduce the cash burn and try to find a way to get to profitability. But of course, this is difficult. At such a large scale, fixing, economic problems that are inherent is just sort of difficult. And so, what happens? The company immediately, starts closing down geographies that were recently expanded. The layoffs start every quarter. They're struggling to find a scalable business model, which is just really difficult when you're already at scale. And so, in the end, the company limps along as a shell of its former self, finally, goes out of business, selling its assets to its competitor for pennies on the dollar. What happened to this rocket ship? Why did we have a company that was doing so well suddenly crater and ultimately not make it? And so the question is, what happened here? If we think about product market fit, subscribers love the service. They had a very high net promoter score. The team and culture, the founders had, recruited a great team. Employees loved working there. In terms of capital, no problem raising money. The top line had been great. The NPS had been great. But did they have favorable unit economics? And I'll talk a little bit about what that means. And in this case, that is really the fundamental problem. The economics of the business were not good enough to make this business work. So you may ask, well, wait a minute, it's okay for a startup to lose money, right? And what I would say to that is losing money overall is okay. And in fact, for a startup, because it takes a time to get to scale, it's going to take a while. There's going to be losses until the company gets to profitability. But losing money at the unit level, that's not okay. And so you may be reminded of the old joke where one merchant asked another one, so, hey, if you lose money on every sale, how do you make a profit? And the other merchant says, well, that's easy. I just make it up in volume. And it's kind of a silly joke, right? Because obviously you can't make it up in volume. So, but you'd be surprised how often I see this in the market. So the question is, what is economics? Like, what do we really mean by economics? And so let's break it down a little bit. I mean, unit economics sounds a little jargony. And so let's break it down. So unit is really just the most basic element of a company's business model. So think order, customer, the basic building block of whatever it is that you're selling. And then economics is just the direct revenue and expenses of that unit. So sometimes it's referred to as contribution profit. So the profit that is left over after the revenue and expenses of the order or the customer, whatever the unit is. So let me give you some examples. So the easiest one to understand, I think, is e-commerce. So, if we had an e-commerce business that had low to no repeat, then, it'd be pretty simple. It's really just the order. And so unit economics for an e-commerce business with very little repeat customers is just the cash received for the order, less the expenses to deliver that order, less the sales and marketing expense to get the customer to the website to do the order. So pretty straightforward. If you have a enterprise software as a service business, it's a little more complicated. The primary economic unit is usually the customer account. And a secondary economic unit is the sales rep, where you might have to ramp that person over time before they actually get to achieving their full quota. So that one's a little more complicated. Now, in the example that we talked about earlier for this subscription box company, for consumer businesses, particularly subscription businesses, the unit is almost always the customer cohort. And so you may ask, well, what's a customer cohort? So for consumer subscription, which could be software as a service, or it could be a Netflix entertainment kind of thing, or it could be, in our case, a direct-to-consumer box, subscription box. The economic unit is the customer cohort, which is a group of customers that signed up in the same month and typically from the same marketing channel. And so you can see there are other types of examples. What I'll do in the rest of this presentation is talk more about the consumer subscription business, because I think that one captures a lot of the elements of other types of businesses. But if there are questions in the end, I can address some of these other models. So for a business that has upfront customer acquisition, but ongoing revenue streams and profit streams in the future, sometimes it's useful to look at the value of the customer unit. So one of the things that you may see in terms of unit economics, it's often mentioned in the same sentence, is customer lifetime value. And it's abbreviated sometimes as CLV or LTV or sometimes CLTV, but it's all basically the same thing. Really what we're talking about is the total value of the customer over that customer's lifetime. And this is the kind of analysis sometimes I see, particularly from kind of earlier stage companies. And so that, it might go something like this. So, let's take our box company example here. So we're getting on average $20 from each customer. And the average subscription lifetime is 20 months. And so the founder maybe, has gone out and looked on the internet and said, okay, if I take the most recent average churn rate, which is just 1 minus the retention rate, and I divide 1 by that rate, I get about an average of 20 months. So, okay. So now I've got a customer lifetime value of $20 per month times an average lifetime of 20 months is $400. And that's not quite right, as we'll see in just a minute, but this is something that I often see. Then there's the other side of the equation, which is customer acquisition cost, often described as either CAC or sometimes in subscription businesses, subscriber acquisition cost, SAC. And that's a little more straightforward often. So, say, well, okay, I spent $10,000 in marketing expense and I acquired 100 customers. So my CAC here is $100 per customer, something like that. And so, if you take the ratio of these two things, you say, okay, we've got $400 in CLV and $100 in CAC. I've read somewhere that 3x is kind of where I should be, at least 3x. And so this is more than 3x, this is 4x, so we're good, right? Not quite right. So this isn't really what you want to do. And I'll kind of go through why these kinds of mistakes are often not the right way to look at it. Okay, so the first thing is that revenue and value are not the same thing. So when we're talking about customer lifetime value, we're talking about the stream of contribution profit over time from that customer. There's a lot of places out there on the web where people talk about lifetime value and they're really talking about lifetime revenue. And that's really not quite right, because as you'll see here, when I go through this example, there's a lot of cost in there that you have to take out when you're talking about value. So let me just take you sort of from the left to the right here on this waterfall chart, and I'll explain what I mean. So on the left-hand side, we've got gross revenue. So gross revenue is the $20 that we're charging the customer each month for the consumer box. But you have to take out a bunch of other things. And the first two things you have to take out are discounts. So for example, let's say that we give a customer a 50% discount or 20% discount on the first month. That has to come out. If there are returns of the product, then that has to come out. And then you get down, so let's say that that's $3 and $2 per customer per month, respectively. Now we're down from $20 to $15. And by the way, that's the revenue that you actually report. So from an accounting point of view, you don't actually report the $20 on your financial statements, you'll actually report the $15 per customer, because the discounts and the returns are things called contra revenue. They don't actually count in your revenue. So now we're down to $15. And we've got, let's say, between shipping and the cost of the items, maybe that's $8. The credit card fees, every time we do a transaction, it's 3%. So that's another 60 cents. When we get tickets in for problems with orders or questions or whatever, we have customer support costs that have to be factored in. So all these costs have to be taken into account. And if you sum up those costs to the right, they end up being like $10. So we go from $20 in gross revenue to $15 in net revenue to, we have $10 in expense. Now we're down to $5 per customer per month. And you can see that's wildly different than $20, per month, right? And so, when you're thinking about lifetime value, it's this $5 on the very right after you've already taken out all your costs. That's the actual value. And it's that over time, it's not the $20. So that's a rookie mistake that you can, if you just learn one thing from today, if you don't use revenue in your lifetime value calculations, you'll be ahead of the game. The second thing is on customer acquisition cost. And I do see this one quite a lot as well, which is customer acquisition cost is really about paid channels. So, another common problem is when you blend paid and unpaid customer acquisition. So imagine that you have 30% of your customers that come in, through the website and through PR and friends and, channels that don't require you to actually pay for Facebook ads or Google ads or whatever affiliate to get customers to your site. Then, so if you're paying really $150 per customer for 70% of them and $0 for 30% of them, and you average it out and you say, well, on average, I'm paying only $100, that's not quite right either. Because really, the paid programs are what you're going to scale up. And when you scale it up, you're going to be paying $150 per, you're not going to be paying $100, and that makes a big difference. So, no blending of paid and unpaid channels is just super important when you're talking about customer acquisition cost. So in addition to contribution profit per month and customer acquisition cost, there's also how long does a customer stick around? And so for subscription businesses, I often get asked the question, what's a good retention rate? What's a good churn rate? What's a good retention rate? And, as I mentioned, retention rate is just the positive version of the churn rate. So if you have a retention rate of 90%, you have a churn rate of 10%. They're just mirrors of each other. And so people say, well, what is a good retention rate? And that really depends on what kind of business you're in and what kind of customers you have. So for example, if you're in an enterprise software business and you have, so let's say, enterprise subscription, software as a subscription business, and you have enterprise, like very large customers who, it takes a long time for them to buy, and, you have a lot big implementation. If you're seeing churn rates that are greater than 3 or 5% a year, then that's not good. So you really ought to be kind of less than 5% a year for enterprise customers. If you have smaller customers like mid-market or small and medium, you might see churn rates of 10 to 15%. And for, startups, you might see, 20, 25%. It definitely, as the companies get smaller, the churn rate tends to go up. Now for consumer businesses, these are a little bit different. And if you can see the slide here, and I assume if you can't see the slide, then you'll let me know that the people can't see the slides. But so if you look at this slide here, this is what's known as a subscriber retention curve or a cohort survival curve. These are the kinds of charts that you'll see if you're running a consumer subscription business. And so on the y-axis going up and down, what you have is the subscribers, the percent of the original cohort that are still active. And on the x-axis, what you see is the month since acquisition. So, when they first sign up, obviously there's 100% of them that are active. And in the first month, then you have some churn, and if you look at the very top line, you've got about 30% of the customers that originally signed up are there in month one. And so 30% leave and 70% are left. And then if you go to month 2 for that gray bar on the top, you'll see that we lose another 10%. And then if you go to month 3, then we lose another 8%. So you can see how the curves are flattening as we go through the months. And this is very typical for consumer businesses, as the retention rates, as you get more and more loyal customers over time, the retention rates, the churn basically gets better over time for these cohorts. Now, one thing that you'll notice in this slide is that if you look at 2 years ago versus a year ago versus this year, and you look at how this is trending, and let's say that this is our subscription box company, the curves are definitely getting worse. And so this is something to stay vigilant about, is to say, look, what is happening with each of the cohorts over time? Is it getting better or worse? And in this case, for this particular company, it's getting worse, and in fact, quite a bit worse. And that's something to be concerned about. If you look at it by channel, and here we've just got an example of breaking out the retention from unpaid channels and paid channels for this particular box business. And you can see on the left-hand side that while the unpaid is getting a little bit worse over time, they're actually flattening out, and we still have kind of 30% or so of the cohorts after 18 months are still with us as active customers, and that's something that you could start to build a business on. But if you look at the paid channels, 2 things you'll notice. One, they're getting quite a bit worse over time, right? So maybe we're finding, as we go out to more and more marketing channels that are less, good for us, the customers are getting worse and worse. And then the other thing is that these paid channels don't do nearly as well as the unpaid ones. So we're actually got less than 10% of the customers are still with us after 18 months. And so this means that we're churning through our cohorts. And so if we're acquiring customers and then suddenly the vast majority of them are gone after 12 to 18 months, then this is a real problem. It's a difficult way to build a business. And this is likely part of our problem about why, this business ultimately isn't going to make it. So how can you, measure how all this plays out in terms of retention and revenue and customer acquisition cost? Well, I think one of the best tools is to use a CAC payback chart. And this one's a little complicated, so I'll try to take a few minutes to walk you through it. So in general, one thing that you may hear out there is, how many months does it take to pay back the customer acquisition cost? That's an important thing that you need to know about your business, particularly if you're doing paid acquisition. And so in this chart, I'll just walk you through. So from top to bottom, so on the top, we have the cumulative net revenue per subscriber. And you can see that it kind of starts out at, around, a little bit less than about $15, which is kind of what we had talked about in that waterfall chart. And then it goes up and we end up around, sort of $75 after 24 months, something like that. And you may ask, well, why does it have that bending shape? And the reason is that because the retention curves are sloping down, we're definitely increasing revenue over time, just not as fast because we have fewer customers around. So that's the top line. And then if you go down one, then those are the direct expenses, the cost of goods, the discounts and so forth associated with serving those customers. And then the green line is, you can sort of think about that as the customer lifetime value. That's how much the customer is worth after 24 months. And obviously it keeps going, right? It keeps going after 24 months to, 36 months and 50 months and so forth. But you can kind of see where we are at 24 months. And then the flat line just below that is assuming we're buying customers at an average of $25 per customer. And in this case, we're assuming it happens in the very beginning versus, requiring more spending to retain that customer over time, assuming that's just all up front. And then the bottom line is the most important one. It's, okay, how long does it take us to get from, negative territory to break even. So the 0 line, you can see where the little arrow is pointing. In this case, it takes us about 7 months to generate enough contribution profit that we've paid back the customer acquisition cost, and everything after that is positive and starts to contribute contribution profit to, funding growth. Essentially, it becomes positive. And so, in general, what you want is less than 12 months. And from the CFO's point of view, I like to see less than 6 months. But definitely, if you start getting into the 18 months, 24 months, that's a long time for the customer acquisition cost to pay back. And that's going to consume a lot of capital in terms of growing the business. Now, you may ask, okay, what happens, if it never pays back? And you'd sort of say, well, gosh, that doesn't seem like it makes any sense. And I would agree, it doesn't make sense. But let me tell you, often I see this quite a bit. And not maybe not for an entire company, but for large swaths of marketing spend. And here's what tends to happen. What tends to happen is, let's assume it's the same retention as what I showed you on the previous slide, but imagine that we offer a discount, 50% discount to get people to join the service. And instead of paying $25, we pay $35, which doesn't sound like much more. But the reason, but because we have such dramatic, drop off in retention, what happens is we lose about $40 to start, and we never get to 0. Okay, so this is the kind of thing where if you have large portions of your business that look like this, where customers never pay back, you're basically, you might as well take a suitcase out and just dump the money on the street, because this is, while it's propping up your top line growth, it is absolutely wasting expensive capital. And this is a huge no-no. And definitely, investors that are very analytical, will pick this out very quickly, and you'll be in trouble. And so trying to fix these kinds of problems when you're already at pretty big scale is very, very difficult. So just to summarize the common mistakes and solutions. So, like I said, ignoring unit economics, my argument is, look, it's a key part of developing your company, and you don't have to absolutely nail it as an early stage company, but you ought to be looking toward what it's likely to be. As I mentioned, using revenue for the CLV calculation is a total rookie mistake. Definitely don't do that. Contribution profit is what you want. Measuring average customer churn, particularly in a subscription business, again, not what you want to do. You want to show those cohort curves in terms of how well they're retaining over time based on how long they've been with the company. And the last one is blending the unpaid and the paid CAC. And my preference is to show the CAC payback by channel. I think that's the most rigorous way to do it, and it'll keep you out of trouble. So just to wrap up here, the prepared remarks, so for early stage founders, what would I suggest that you do next? The first thing is, look, there's a lot of pressure in Silicon Valley to grow as fast as possible. And it's definitely true that growth solves a lot of problems. Unfortunately, unit economics is not one of those things that it solves. And so I think it's worth, as an early stage founder, deciding if you're going to commit to having a solid unit economic model, before you get to a point at which it's too difficult to fix. And that's really just a mindset and a commitment to not pursue growth at all costs, but pursue a model that is really ultimately going to be sustainable and could weather, being in later stage markets where, honestly, having a path to profitability is, required. And if you can't do it, you get punished. So that's the first thing. And then the second thing is, like I said, even if you haven't, I don't think it's important to nail the unit economics. But if you are starting to identify what the unit is for your particular business, and even if your early customers and customer acquisition cost isn't really going to be reflective of what it's going to be in the future, at least having some sense of like, well, what could it be? What if, asking those kinds of questions, and having a view about what it might be as you raise more capital and scale the business, I think is a useful exercise. As I mentioned, measuring CAC payback, I think, is paramount. And, stay vigilant on it. It's not something that you sort of measure once and then a year later, you kind of like, we already know what our economics are. The economics can change. And so it's worth looking at it, certainly every quarter as the business develops. So I'll stop there and answer any questions that you may have.
Okay. Wow. First of all, loved how you explained these really difficult concepts so clearly and simply. So Trey, you are a pro.
Thank
I
you.
want to just read off actually one of the questions here just really quickly. So for founders who want sort of to dig deeper, are there any books or resources or anything that you'd recommend for them to dig deeper?
Yeah, that's a good question. There are some really good, I think a lot of the, the VCs that invest in, these kinds of businesses do a pretty good job. I know that, Fred Wilson you had on to kick off the thing. He's got a great series of articles on this topic. Matrix Partners has a really good set of tools. People haven't gone into as much detail on the CFO side of it. And so if you're interested, reach out to me afterwards. I'm developing some materials that I think would be useful for CEOs. It's a little more tactical, kind of from the CFO perspective. So I'd love to hear what people would be most interested in.
Awesome. Okay, so we're going to go now to audience questions. So for the first question, I'm going to have to call on my buddy, Sunny. Sunny, go ahead and ask your question.
Oh, good. I'm so happy. Hey, great presentation, Trey. Really appreciate it. And some of my best friends are CFOs.
Right, exactly.
So let's talk about CAC fully loaded. Let's go back to your subscription box example. And you've got the marketing heads doing Facebook paid, Google paid, and maybe some traditional advertising. Okay, so we know the paid media. But then we also have a staff doing social media engagement. We've got a marketing director. We've got a small team of, let's call it 5 people. So what do you load into CAC?
Yeah, that's a good question. So for those of you on the call, the question is really about how much, like which of the marketing expenses should be in customer acquisition costs and which ones really are not, sort of incremental, if you like. And so the way I think about the problem is kind of twofold. One, how much media spend, truly variable expense versus the size of the fixed expense. And so if the media spend is, way in excess of the actual team, then you could sort of say, well, look, the team is sort of a fixed expense and the media spend is really the variable part that I'm going to put in CAC. So for now, I'm going to ignore the fixed expense. However, there are businesses that, require quite a bit of hand-holding, and so might make, so for example, if you do a lot of, social media kinds of stuff that generates a lot of top of funnel, and that's a big expense, because you got a big team doing it, then I might sort of say, okay, look, that expense is getting kind of big, and so we're going to have to come up with some sort of sensible way to allocate that to the leads generated, if it's a B2B business or if it's a B2C box company, kind of the customers acquired in some sort of sensible way. And I don't really, marketing attribution is a whole nother, sort of can of worms. And so from a CAC point of view, I try not to really, make it too complicated. Let's just come up with a method that we can all live with and just do it every month. As long as we do it consistently, I'm okay with it. So it's kind of a long way to answer your question, but for me, it's a question of proportionality. And if you were to double your marketing spend, would your staff double, those kinds of questions.
Awesome. Trey, can you go ahead and stop sharing your screen so we can see you full when you speak?
Oh yeah, sure. Sorry. Let me
okay. And then we're going to go to Sanjay. So Sanjay, go ahead and unmute, put yourself on video and ask your question.
Sorry about that. I have a covering so Facebook can't see me.
Hi, Sanjay.
I appreciate your session here. I think that, this is one of the most concentrated things people can work on when they're doing a business. Been to 4 accelerators, I think 5 now with Draper University. So this is an awesome talk. How do you feel about pricing for investors that are customers? Like, how do you work on unit economics with somebody who's, they're testing and using a technology that's brand new. They've also invested in your company, but also you have to make money. Like, you got to pay rent. Like, they invested in a business because they believe in the technology. It's going to be a great product, but also, I mean, they got to pay for it at some point, and they got to set the pace so that all their friends pay for it and that your business grows.
Yeah, and so Sanjay, is your question about early stage pricing and how to set that? Is that what you're getting at?
Yeah, with especially with people that put money into your company and that,
Oh, okay. So they're both investors and customers.
Yeah.
Yeah, that's always tricky. Look, I mean, investor customers, I would sort of say, you're really looking for feedback on the unless that's your target market, is we're going to sell to investors. But, that's a little bit like selling to your mom. You know what I mean? Like, it's hard to get real feedback, about the economics and the value of the product from someone who has a vested interest that way. And so I would, I think it's okay to sell to them, and it's okay to ask for them to put, some skin in the game, but I wouldn't draw too many conclusions from how that part of the business is priced, either high or low.
For sure. Well, my question really draws from the fact, like, so in farming, like say your farming investor owns like 10 to 30% of a market, but when they put 0.1% down to test the product, you have to give them a great deal. But when they want to expand to 5% or 10%, like when somebody owns 30,000 acres or 500,000 acres, or in a smaller market, say 100 acres, like certain crops, I mean, that is a huge portion of the market. So you have to figure out how to include these people, because, it's, in some markets, an enterprise, they're the only people that want to put up capital. I mean, at a good deal.
Yeah, I don't have a great answer for you other than, it's tricky to sort of deal with folks that are investors and customers at the same time.
Okay, we're gonna just make sure that we cover a lot of folks' questions, and I see a bunch here. So let's go to Carolyn next. Carolyn.
Hi, can you hear me okay? Hello?
I had a little bit of feedback, so if you can unmute something.
Okay.
I think that's better.
Is it better? Oh, wow, I'm hearing the feedback too.
All right, why don't we go to Alifia, and then Carolyn, let's get back to you next if you can figure out. Alifia, go ahead. Might take a couple seconds for my team to unmute you.
This is great. So I'm new to CAC and CLV I've heard before in one of the companies I worked for. So this was just tremendous, this talk today. Thank you, Trey. One thing that got my attention, because I am in strategy and planning, and so we look at the economics are super important, and then we work with finance, obviously, with planning, as well as the business units. The first part of what you said, losing money overall is fine. What did you mean by that exactly?
Yes, it's a good question if I didn't make it clear. So if the business is a startup, and imagine that you've got a certain amount of fixed cost to develop the product and pay for the engineers and all of that, and it's just going to take you a while to accumulate the number of customers that you need to make a profit overall, then that's okay. As long as you're making some money on every customer, we just need to add more customers. And then let's say we have 100 customers today, but as soon as that we have 1,000 customers, then we'll be profitable. But if you have 100 customers today and each one is losing $1, then when you get to 1,000 customers, the situation is just worse. Does that make sense?
Okay, I think you said that makes sense. Awesome. Okay, so Carolyn, we're gonna go see if you fixed your audio issues, and if not, hopefully my colleagues can paste your question and I'll ask it.
Okay, can you hear me all right?
Yes.
Okay, wonderful. So my question is, if we're using non-paid advertising, if we're using word of mouth, content marketing, partnerships, those kind of things, is your advice for an early stage company to use a different metric for CAC, or should we use salaries if we're taking like a portion of salary, if we would be taking a salary? How do you recommend that?
Yeah, that's a good question. And often for, especially for B2B companies, business to business companies, software companies that have, kind of large staffing, it's more program than media spend. It is more typical to include salaries and benefits and, sort of all the people costs in an agency, if you're using an agency, into the CAC number. And so, so I would probably do that. If you're not doing a lot of unpaid, I would probably think about it as, okay, what is the total expense in terms of people and any variable spend that they're doing in terms of a little bit of advertising or whatever. And I would put that in the CAC number.
Okay.
Okay,
thank
awesome.
you.
Let's call on Saba next. Saba, go ahead.
Hey, thanks for the awesome reminder about unit economics. Do you have some extra reading that you recommend, whether it's a blog or a framework or a book that would help us to continue to do this on an ongoing basis? I'd love that.
Yeah, that's a good question. And, I've gotten a request to kind of do more. I think certainly Ha will make these slides available. There are, like I said, VCs, and maybe Spero has material. I know Ha has done a great article. Ha, you should definitely post that on unit economics. So it's probably worth checking that out. But what I'm hearing is that there's probably some need for some sort of, sort of primer, kind of operational thing that would help entrepreneurs and early stage founders get it right.
Yeah, we'll try to compile some resources for you, but absolutely, there's a few VCs. David Sachs is another one. That's a few great blog posts on unit economics, and I'll write some more. Maybe I'll get some of my colleagues to write some more on it, and then of course maybe we'll bring Trey back for the 201 course here. Okay, so we're gonna go and go to Stephanie next.
I think I'm unmuted. Hi, how are you?
Hello.
I'm rather backlit. So economics has the joy and pleasure of being looking in the rearview mirror, which is part of what I love about it. So for those of us who are in more of the pre-seed stage, how do we take a lot of these frameworks and models and use them to actually look out and say, what do we want our unit economics? What do we want our cost per acquisition to be and to look like? To really set ourselves up to be asking the right questions looking forward instead of just looking backwards?
Yes, that's a great question. And so if I could summarize, it's, hey, if you're really early stage and you don't have any data, what do you do? And for me, I mean, when I'm sort of working with earlier stage companies, it's more of an exercise in a couple of things. One, what do you have to believe for this to work? So, a simple kind of Excel sheet on, okay, if customers pay this much and they retain at this rate and they upgrade to the premium package and it cost us Y dollars to acquire them, does that work? So that's one thing, kind of doing what do you have to believe and how sensitive is the model to that sort of thing. And then the other thing is looking out into the market to kind of say, okay, what have other people done? So, what kinds of customer acquisition costs do I think are in my market? You can also do little tiny tests to get a lot of data. Like, okay, if I run a Facebook campaign, how many people click through and sign up for a landing page? Is it 10%, 1%? Like you can get sort of like very cheap data when you're an early stage company pretty easily that will help you answer some of those questions. Does that help?
Yeah, absolutely. Thank you.
All right, we're going to go to Ruthie next. Ruthie.
Hey, how's it going? I was just wondering a little bit more about how you think about testing something earlier stage, like a beta, early version, and price testing around that. Like, do you generally think of that as something like free, highly subsidized, or just test out the regular price and kind of as you're trying to understand a little bit more about the unit economics of your business and what that might look like long term?
Yeah, it's a good question on pricing. And, sometimes when I talk about product market fit, or I think the people that know a lot about product market fit, price is really an important part of that, because you can have great product market fit, but if it's not at the right price, then, it's kind of hard to make the model work. And so, from the CFO point of view, the way I think about price is, I'm not an expert on pricing. There are people that definitely do that kind of work and are really good at sussing out from either business to business customers or consumers, like what would people pay for various things. But what I do from the unit economics and the CFO point of view is to kind of say, okay, at various price points, how much difference would it make to this business? If we charged $29.99, this is for a consumer business, we charge $29.99 versus $35.99, how big a difference is that? And for some businesses, especially if you're got actual cost of goods, it makes a huge difference. Pricing is by far the most important lever across any business that I work with. And so, there's often a huge amount of delta in the unit economics depending on where the price, comes out. And so I think for early stage founders, spending a lot of time on the value proposition versus price is really worth the time.
Awesome. Okay, next question. We're going to go to Zhao. Hopefully I didn't butcher that. Zhao Almeida.
Yeah, that's perfect. Thank you. Trey, I would like to ask you a follow-up question on a question that was made by Sonny before on CAC. So let's say a case of a B2B company that has a very large field sales team that is highly dependent on that for acquiring customers. Even though you position like the team costs as a fixed cost, would you say that in this case you would include it on CAC calculations on the comparison?
Yeah. For B2B, software sales or B2B businesses of any kind that have either field or inside sales, absolutely that should go into CAC.
Awesome. Thank you.
All right. Wow, we're getting through a lot of questions. That's amazing. Okay, so we're going to go Candace next, and then James, you're on deck. Candace, are you still here? Okay, so we're going to go to James, and then maybe Candace, my colleagues will tell me if Candace is still here or not. Oh, Candace said that his question was answered. Okay, so James, take it away.
Hi, Trey. Great talk. Thanks a lot. Quick question first. I want to follow up again on what Sonny was asking about CAC. We pivot to focus pretty much mostly on B2B now. But on B2B, there's a different layer of customers. There's a big groups. And there's different brokerage firms, there's even individual agents. Mm-hmm. So when we calculate the CACs, right, would you say, like one group we're working on has like 100,000 agents. Mm-hmm. And it takes really long time. Like we've been already almost 5 months and it's a lot of connection, but once it's through, it's going to be huge. I mean, but the individual brokers, like some broker might have like a few hundred agents, but some of like individual team of agents. So when those calculating the CACs, do we pretty much average out, or would you say just focus on what part of the segment you're targeting and just using that right now?
Yeah, so the question is, what do you do if you have a B2B business and you have very different customer segments? So I think it sounds like in your example, you've got one customer segment that, you know, if you land that deal, it's a massive deal with maybe hundreds of thousands of users versus smaller brokers. Am I understanding the question correctly?
Yeah.
Right. So, yeah, so, and I do have clients that have similar situations, right? Where they're, you know, they're doing elephant hunting, plus they're selling to smaller companies as well. And I think what you really want to know is, okay, for each of the customer segments, how do you get new customers? How much does it cost you to get a new customer? And so the more customers that you're signing up, the more a demonstrable model you need to have, you know? So if you're just doing like one or two very large deals a year, sure, you could put all the customer acquisition cost in there and, you know, but you know, that's a little bit, it's hard to kind of say that that's a model, right? You know, because you're hunting these giant customers. Whereas for the brokerage business, if you're saying, okay, look, you know, here's the way it works. We get 100 leads in, and, you know, we have to spend $1 per lead to generate 100 leads. And each of those leads, you know, turns 30% of those are sales qualified. And then of the 30, you know, this is how many we convert into an actual customer. You know, then you can start to get an idea of like, okay, what is the CAC at each stage and in total to sign up one more brokerage customer?
Actually, I want to follow up a little bit more. This is interesting because another side of it is that, like, one feature of ours, it's very cool. Like, nobody in the industry has those kind of features or reports. Like, and we can sell this to this whole group. We can sell this to individual agents, or we can sell it to agents, clients, which is general users. So in other words, like, one report, I can actually sell to different people. But like if I sell to different segment of users, like say for the main group, then I won't get a chance to sell to individual users down the road. So which might bring a lot of sales, so would you say how to balance those kind of situation?
Yeah, I think that's a little more of a customer segment, target customer, and channel discussion, which is a little bit outside of what we're talking about. So yeah, I don't have any specific advice for you on that, other than, yeah, you got to think carefully about who that customer is.
Okay, I see we have 7 minutes left, so let's get through 3 more questions. So let's go ahead, Randy. Randy, go ahead. Randy? Awesome.
Hey, my apologies. Thank you for this opportunity. Anyways, I wanted to follow up with a question regarding the CAC and which you already partially answered, had to do with for a B2B business, and you're doing direct sales. We would, I assume that to be fully loaded, we would include the salaries plus commissions for the CAC. But the follow-up question with that really is for the lifetime value. Anything over 2 years, should we have a discounted rate for that, for the money on that after 2 years? Or would you suggest that we do multiple analytics for one variant of 2 years, another one for 3 years, another one for 4 years, with different churn amounts based on those years?
Yeah, no, that's a great question. So the question is, how long, if I understood correctly, how long should the customer life be, particularly for B2B customers, 3 years, 4 years, 5 years? And should you use a discount rate, which means that money in the future is worth less in the future than it is today? And yes, I think the answer on the second question, yeah, I mean, typically using a discount rate is the proper analytical thing to do. In practice, is it really done? Less so, less so. I would sort of say, for enterprise, it kind of depends on what kind of market you're in, but for enterprise customers, 3 to 5 years, probably the right time frame. I could be convinced on 5. But I think it ultimately kind of for that, it's like, how quickly does that CAC break even? And then, because anything after like 18, 24 months, if you're not breaking even by then, you've got a problem.
Awesome. Okay. Oh, Randy's good. Okay, Mitten. We're going to go to Mitten.
Oh, Hello, Trey. Thank you very much for all your insights. Great insights there with respect to CAC and LTV. I want to follow up on the same question a little bit more. Let me try to expand this. If you look at it, you could, in an early stage company, it's very hard to determine what's the actual average life of a startup with the customer. So do you just take a fork and say, okay, 24 months is my calculation, or do you benchmark it against the industry? When I say that, for example, supply chain industry. In the supply chain industry, I know that on an average, the contracts are long-term. So I end up, the ACV is going to remain for next 5 years. So I'm going to take the average ACV. What's the kind of recommendation you have? And the follow-up there is, if you are operational more than 2 years, would you look at your past 2 years of customer base and average it out and say, okay, this is the average lifespan of the customer in our LTV calculation? I'm assuming the CAC payback period is less than 6 months.
Yeah. So, I mean, it's a question of kind of like, what are you trying to decide? Are you trying to decide how much to spend on acquiring a customer? I mean, for B2B customers, you know, a life of 3 to 5 years, I think is perfectly fine, you know, assuming some sort of, you know, 3 to 5%, you know, churn, and maybe churn is offset by some expansion revenue or something like that. You know, on the CAC allocation, you know, I try to attach the actual CAC to the customers, you know, so if we spent, you know, $250,000 on customer acquisition last quarter, you know, how many customers did we get? And, you know, basically try to attach the CAC to the customers, as opposed to kind of just peanut buttering it across everything. Sure.
Thank you. Can I ask a follow-up? I have a follow-up on the CAC and LTV. Would you consider CAC and LTV to be bigger measures, or would you look at dollar revenue retention rate on absolute dollars?
I think investors that make software investments are much more concerned about, you know, a different set of metrics, which we haven't talked about today, which is ARR and the characterization of ARR in terms of how much is new and retained and expansion and contraction and things like that, you know, for the customer base, and then how long it takes to kind of, you know, how much you're spending in CAC to get to those revenue numbers. I think people are increasingly kind of looking at the customer lifetime value calculation, particularly just that static cut, as sort of being a little bit too academic, honestly.
Sure. Got it. Thank you very much, Trey.
Okay, so I lied. I'm gonna do 2 more questions. So one is second to the last is Pian Pian. Go ahead, Pian Pian.
Hello, thank you for presenting and for sharing your thoughts. So I'm curious, how would you suggest to calculate cost per acquisition for channels that will take some time to convert, and also its cost per impression base, for example, like Facebook ads or even marketing, brand advertising? Thank you.
Yeah, no, that's a great question. And so I think the question was, if I could summarize it, is, hey, if you're spending money, particularly on top of funnel kinds of things, it takes a long time to for it to roll down into customer. How do you allocate that? And the short answer is there's no set way to do that. Typically what I do with clients is just come up with a methodology that seems to make sense in terms of how the costs get allocated to leads and to parts of the funnel and ultimately to customers, and just do it consistently quarter after quarter, so that you can see because the key thing is how is this trending? Is it getting better? Is it getting worse? What's happening? And I wouldn't get too concerned about, are we getting it exactly right?
Okay, so the last question comes to us from the Factor, but I'll go ahead and ask it in the interest of time. So the Factor asks for hardware software products. So let's just use Peloton as an example, right? You buy the bike and then there's an annual subscription or sometimes a monthly subscription. So does that change the LTV calculation at all, or the payback, or how do you really think about hardware software combination businesses?
Yeah, that's a really good question, and Peloton is certainly a top of mind, example, right? Since their business is doing, I'm sure, so well right now. So yeah, for hardware, software, it depends a little bit on the margin structure of the hardware itself. And so if it's a razor blade kind of model where there's a loss on the initial hardware, but the subscription makes up for the difference, the software makes up for the difference, then I think you think about it in the same way of my example of like, kind of the cohort, right? So, we sell the hardware at a loss, and we're betting that we're going to sell enough razor blades that ultimately it makes up the difference. And so if it's a bundle and you can't really unbundle it, you could do Peloton without the bike, but the bike is the most important thing. And in the razor blade example or the laser printer, if you're selling the thing and it loses money, you have to figure out how much you're going to make over time with the bundle if they can't be unbundled, if that answers the question.
Awesome. Trey, amazing session. I'm glad you're not charging me overtime for running a little bit over.
Happy to do it.
But I think, well, first of all, actually, I'll let you close it off. So I know you probably have a bunch of founders who are interested in working with you. What's the right stage to be working with you? Kind of at what maturity of businesses, and especially not just you, but as they think about hiring their first CFO or maybe interim CFO, what's the right stage?
Yeah. Typically, so I typically work with a little bit later stage companies than where I think the most of this group is. So typically, people have a commercial product out there. They're either selling it or they're launching it, or they're now selling it in the market. If it's a B2B product or a consumer product, so kind of Series A, B are my typical clients. That said, if you're looking for, kind of business model help, there are one thing you can consider is, and I do some of this work, is more of a part-time CFO. And so if you go to my website, there are a bunch of firms that do, this kind of thing in addition to me if I'm not the right fit. And it can be really useful to you don't have to hire a full-time CFO, but sometimes having a part-time person just to spend a little time helping you think through the model, can be a good investment.